If you've ever spoken to an insurance agent from different companies, you will realize that there is a difference in the pricing, even though the policies that they are recommending appears to be similar. Now, have you ever wondered what is the cost for this discrepancy in pricing, and are you being shortchanged or overcharged? Now, in this video, I will explain to you the components that goes into the insurance pricing and whether or not it makes sense for you to pay more or less for a given policy. Without further ado, let's get started. What forms up the premiums and why is there a difference? Now let's talk about what goes into the price of an insurance policy. Generally, the price of an insurance is a combination of three main factors. Number 1, probability of claim. The first factor of insurance pricing deals with the probability of claim, and naturally, a higher probability of claim will result in higher price, vice versa. That said, depending on the type of insurance coverage, I would argue that most insurers are dealing with similar numbers when it comes to the probability of claim, as all of these statistics are affected by the law of large numbers. To generalize, the law of large numbers in insurance dictates that with enough sample size, it is possible to accurately determine the percentages of people that will make a claim. Now, the only thing that may differ for the first factor is if an insurer provider provides a broader scope of coverage than what the other companies are offering. For example, instead of 35 critical illness conditions, the insurer may provide up to 73 conditions. And in theory, by having a broader scope of coverage, the company now exposes itself to a higher probability of claim, and hence the price of the insurance has to go up accordingly. Now, if the scope of coverage is identical, the probability of claim that the insurers are working with should be the same, and hence the pricing should not differ between companies. Of course, in reality, that is not always the case, which brings me to my next point. Number 2, investment returns and performances. Now, the second factor of insurance pricing deals with the investment returns of the insurers. By theory, a higher investment return will signify a lower insurance pricing, as the investment returns can help offset the claims payable and operating expenses. That said, no one knows the degree to which it is being practiced in real life, as not all the investment returns will be allocated for the benefit of the policyholders, as the shareholders will want some cut too. And with regards to the differences in the investment returns of insurers, given that insurers often invest in similar manner and asset allocation, over the long run, the expected return between the insurers will not deviate that drastically due to the concept of mean reversion. And this can be observed from the returns of the participating funds of the major life insurers. As you can see, while the deviations in the short run can be rather substantial, in the long run, generally, the investment returns of the insurers are closely approximate to one another. Number 3, desired profitability and ongoing expenses. Now, the third factor of insurance pricing deals with the operating expenses and overheads of the company. Now, all things being equal, insurers that has a higher operating expenses will need to impose a higher price on their policies in order to break even. A company that does more marketing will incur more marketing expenses that the shareholders will not absorb. And naturally, that means that the policyholders will be the ones that are paying for all these additional expenses, hence causing the price of the policy to increase. And apart from just the break-even point, the desired profit margin of the insurers will also affect the pricing that it has to charge after taking into account of all the potential claims and expenses. All things being equal, a higher profit margin requirement would mean that the company has to charge a higher price. Now, of course, as policyholders, we do not have access to this information, but out of all three factors, I would argue that the third factor will have a more significant contribution to price differences across the different companies. Granted, no two insurances is the same when it comes to the benefits that it has to offer, and by focusing on the price difference alone, it will not tell you much about whether a policy is better or not. And that brings me to my next point as to whether or not it is worth paying for a more expensive policy. Is it worth paying for a more expensive policy? Now, assuming that the coverage amount and the scope of coverage are exactly identical, it does not make sense for you to pay more for a policy that essentially provides the same benefits. However, competition exists for a reason, and no two insurer will provide a policy that is exactly identical to one another. If a policy is more expensive compared to another, I think whether or not it is worth paying for the additional price largely depends on two things. Number 1, what are the additional benefits that you are receiving? And number 2, what is the probability of claiming on these additional benefits? For example, it makes sense for you to pay an additional price to be covered for something that has a high probability of claim, such as cancer. But it doesn't make sense for you to pay an additional price if the probability of claim is excruciatingly low, such as Ebola. In situations like that, I would rather you direct the budget to be covered for a higher sum assured with a narrower scope of coverage that has a higher probability of claim, rather than to be covered for a lower sum assured with a broader scope of coverage for things that have a lower probability of claim. At the end of the day, as long as you know and you understand what you are paying for a more expensive policy may be worth it if you deem the additional benefits to be necessary. The last thing that you want for yourself is to blindly pay for things that you do not need, or worse, pay more for no apparent benefits. Now, if you don't know how to get started with your insurance planning, or if you do not have the time to do your market research, you can check out what I do on my website and see how you can benefit from my insurance planning services and reach out to me directly. Subscribe to this channel or follow me on Instagram or Telegram to receive a 1-minute daily market updates and be updated with the weekly upload. Stay safe and I hope to hear from you soon.